The Norman and Florence Brody Family Foundation is dedicated to exploring topics of national and international importance and is proud to support Policy Watch with Doug Besharov at the University of Maryland. From the University of Maryland, this is Policy Watch with Doug Besharov.
The last 60 years have seen enormous transformations in the world economy. At the close of World War II, the United States stood uncontested as the world's leading manufacturing and industrial power. Over the following decades, however, a resurgent Europe and Japan retook their places as major economic powers. By the 1980s, the Asian tiger economies had become major economic players, followed by the rise of India and China in the 1990s. Throughout this period, world trade and competition grew tremendously. What do these changes mean for the U.S. economy in the 21st century? Joining us to discuss globalization's past and future is Desmond Lachman, a resident fellow at the American Enterprise Institute and a former deputy director at the International Monetary Fund. And now, Doug Besharov.
Desmond Lachman, welcome back to Policy Watch and the University of Maryland.
Thank you.
So before joining the American Enterprise Institute, which is a Washington think tank, you served as the managing director, I love these titles, and chief emerging market economic strategist at Salomon Smith Barney. And before that, you were deputy director of planning at the International Monetary Fund for policy development. So you know a lot about the emerging market developing world. With that experience, I'm going to ask you to help our audience understand what's happened over the last 50 or 60 years since World War II. Now, I'm old enough to remember a time in the 1950s when the U.S. was the dominant international trade power. I can remember reading how 9 out of 10 washing machines in Brazil were made in America. Now, surely that was a temporary dominance after the war, but set the stage, if you would, from the 1950s to the time when the Asian economies entered the world market in a big way.
Well, you know, you're absolutely right that immediately after the war, the United States was by far the most dominant power, that we had what was called at the time a dollar shortage. Everybody was scrambling to try to get dollars, that we had Europe in a total mess, that Japan was devastated by the war as well. And I think that what we saw during the 50s and 60s was we saw the European economy, Japanese economy really coming back in a very big way, and the United States losing relative share. I think what also has occurred is since the 50s and 60s, we've got a lot of other Asian countries emerging, following the same kind of pattern that Japan followed. So what we got is we got countries like Korea, which around about 1960 had a per capita income not very different from Ghana or another African country.
They were desperately poor.
Desperately poor. You know, that you were really talking about an African level of development, and through very high savings rate, through a lot of investment, through imitating the United States technology, what you really got is you got these Asian tigers really becoming very dynamic on the global scene and essentially catching up, so that today what we've got is we've got a country like Korea that belongs to all of the clubs, the G10 or whatever, that they're really a real player in the global economy.
Now, hold. Let's go back for a moment. Now, my experience is in dealing with the people in Korea and Singapore and even China today, and not so much in Japan and Germany. So many of them are U.S. trained. So it's also a story about American education that was transferred over there as well. Is that right? I mean, there are many reasons for this movement toward into the 21st century.
Oh, absolutely. Those societies, whether it's a Confucian background or what have you, really value education so that what one's got is one's got a labor force that is relatively well-trained, well-educated, where they put a premium on getting skills. So it's this combination of very high amount of investment, increasing skills, saving a lot. That is the kind of recipe for very rapid growth. What these countries also have is they had the advantage of being way behind the United States in the use of technology. They didn't really have to push the frontier of technology out. What they needed to do was replicate the kind of technologies that were already in existence. So when one saw this in the 70s, you really did get a lot of these smaller Asian countries really developing at the same very rapid rate at which Japan has been developing. This is probably the fastest pace in which countries have gone from a very rural, backward economy to something that is highly industrialized and now moving into the service sector.
Now, is that because of what we call globalization, but the ability to trade?
Oh, absolutely. Following the Second World War, that was one of the things that the United States really offered a lot of leadership in, is to open up the world economy to trade. So we had the advantages.
Because we had things to sell.
Well, we had things to sell, but I think that there was also an interest in helping Europe get itself out of the critical situation that Europe was in at the time. So I don't think, I think that there was a certain amount of self-interest in this, but I think it went beyond that. I think that, the United States saw that this was the right thing to do, to have a stable global economy. That I think that one of the lessons that we learned, in the 30s was when economic systems break down, it's not too good for the politics. It leads to war and all the rest. So I think that there was a sense of altruism, of optimism, that we really had to do things in a different way. And the short and the tall of it is that this is probably the largest expansion of trade that we've known. And there have been very many beneficiaries. It was first the Europeans, then the Japanese, then the Asian tigers, and now we're talking about China and India benefiting from a system that is open, allowing them to sell and to specialize.
So we had the Germans, and they had this fantastic work effort, and there was no better camera than a German camera, and the lenses were whatever, right? And they were going to, eat our clock, or whatever the phrase is. And then it was the Japanese, and they were such fantastic workers, and they bought Pebble Beach and whatever they were going to buy in America, because they had such a work effort, and so forth. And each one of those countries, as they became more wealthy, became more like us, right? And their economies looked more like ours. Their workers wanted to be paid as much as ours, and so forth. The difference with China and down the line India is that these are just much larger countries, and the period of adjustment will be much longer and more disruptive.
Yeah, I think that is the essence of the issue, is that what we're now doing is we're talking about a country the size of China with a population that is something like 4 times that of the United States is now going to be catching up. So this is going to have huge global consequences, even if in the end China's effort sputters, and that they become more like us, and that they don't manage to keep growing at this rapid rate forever. That has to have huge consequences because it's so large. So what strikes me is we're already talking today, China has surpassed Germany as the world's 3rd largest economy. It's expected that in a couple of years' time, they're going to surpass Japan as the world's 2nd largest economy, and it's only something like 10 years, if they continue growing at this rate, that it'll be a larger economy than the United States. So that has to have very different repercussions on the global economy than a Korea being inserted into the global economy. If you've got this occurring at the same time that India is doing the same, I think the consequences, I'm thinking of commodity prices, for instance, that these countries...
Energy.
Energy is a huge issue.
So when we say the size of the economy, that's not per capita. The U.S. and Western Europe will still be substantially wealthier on a per capita basis.
Absolutely.
But it's the size of the economy. And so in China, for example, I believe it's the case that they manufacture more cars than the U.S. So that's not per capita, but that means those cars use as much gasoline. Now, they'd have a smaller stock, but so the price of oil goes up for us as well as for them, and this is going to change our long-term economic situation as well because energy costs will be higher.
There's no question that that is a long-run concern for the global economy. It's both the fact that these countries are growing at a very rapid rate, but they're also not very energy efficient. So the estimates are that to produce 1 unit of output takes something like 2.5 times the amount of energy in a country like China than it does in the United States. So there's energy inefficiency. In addition, what's occurring is you're getting a middle class that is now emerging, and this middle class, the first thing that they do is they want to have an automobile, they want to have a drying machine, they're wanting a washing machine, all of these things that are highly energy intensive. We know that global oil supply is more or less fixed at 85 million barrels a day, that what we've got is we've got depletion of supply in a lot of key countries. I'm talking about Russia, Venezuela, Saudi Arabia. All of these wells are old. Even though new wells come on, we're stuck at 85 million. If we get countries like India and China growing at rapid rates, that means that unless we bring alternate supplies of energy on in a big way, oil prices are headed up, and that has important implications, for the way in which we live in the United States. Surely negative, because what we're going to be doing is instead of getting our oil at $50, $60 a barrel, we could very well be having to pay $150, $200 a barrel, which means that $4 a gallon at the gas pump is going to look like a bargain.
Now, somehow, I think the Chinese are subsidizing the price of energy.
They certainly are. That is something that the Chinese use the state to make sure that higher energy costs don't impact their manufacturers. So there are subsidies going on. I think what else China is doing is it's trying to secure oil supply, enormous amount of investment in Latin America, in a number of African countries, in order to secure supplies, not simply of oil, but of commodities in general. They realize that, if they continue to grow at this rate, that there's going to be huge amount of pressure on global commodities.
Now, in other settings, you've described you're not the only one, but you've described the Chinese approach to trade as mercantilism. Tell us what you mean by that.
Well, basically, mercantilism means that what you do is you support your export sector no matter what happens. And this is the way you try to grow, by the whole way in which the Chinese have set their development policy is to expand their exports at a very rapid rate. So what we've been seeing is their exports growing at something like 25% a year. Now, that was fine when China was a relatively small economy, that if China's exports grew by 25%, that didn't have an impact on the rest of the globe. Today, with China being the world's third largest country in terms of economic size, for them to expect to grow their imports at 25% just doesn't make sense. That what you'll get a very imbalanced pattern of global growth, and that's bound to spawn protectionist pressures in places like the United States and Europe. So one really has to be very disappointed that the Chinese are not taking a more positive approach, a more cooperative approach to the global economic problem right now. What the Chinese should be doing in the global interest and in their own interest is encouraging more domestic consumption and not relying on their export sector to really generate the growth going forward. That would allow the United States to increase its savings and to reduce its dependence on having to borrow from abroad.
When I was in Beijing last, someone said to me, I was saying, what a fabulous, city, what development. He said, well, there's no limit to what 200 million people can do with the help of 1 billion one.
Right.
So I take that's the structural thing. But let me parse what I think you were saying. I think what you were saying is that China had to change its behavior, otherwise other countries wouldn't continue to let it do what it's doing now. Now you called it protectionism, but in some respects that is other countries closing their markets in one way or another. And I think the Doha round had to do with the developing countries opening their markets to each other. So there is the policing on the Chinese will have to come from other countries, not its own economic interests.
What I am very disturbed about is that at the G20 meetings, these are now
G20 as opposed to G7. This
exactly.
is a fact on its own. Yeah.
Well, that I think is another indication of the growing importance of the Asian countries, the growing importance of countries like Brazil, Russia, that they've got to be recognized, that they now are sitting at the table where policy is made. Until recently, policy was made at either the G7 or the G8. We've now invited all of these countries to sit around the table. But what we had is, in December last year, when the countries sat at the table, the one thing that they all agreed on was that protectionism would be destructive to global prosperity and everybody should not really go down the protectionist route. Well, the World Bank has come out with a study recently showing that 17 of the 20 of these countries that were sitting around the table, including the United States, have engaged in protectionist policies that they've put one form of restriction or another, whether they're having an argument about tires in China or Buy America products. This is really a very disturbing development. And my concern is that if unemployment stays very high in the United States and in Europe, that China really should not expect the markets of the United States and Europe to stay open to it. And it's in its own interest, I think, to forestall the protectionism.
Now, wait a second. I'm not an economist, but do I remember some parable about a frog and a grasshopper?
I'm familiar with the parable.
Yeah, well, tell our audience about it, because I think it doesn't work out the way you think this China story should work out.
Well, hopefully the scorpion's not going to sting the frog before it gets to the other side.
Yeah. So the story is, right, the frog says, so you tell the story.
Well, I think my recollection of the story is the scorpion wanted to get to the other side of the river, so it asked the frog whether it would take it across. And in the middle, the scorpion stings the frog, and the frog asks, why...
And then they're both about to sink.
Exactly. So the frog asks, well, why did you do this? And the scorpion explains, well, that's really how it happens in this part of the world.
I'm a scorpion. I'm still a scorpion. So this is what troubles me.
Well, I think that the analogy perhaps isn't really quite correct, because I think that what you've got to see when you look at China is you've got to look at a difference between what's in the interest of the country and what's in the interest of the political class. And I think that the political class is very reluctant to embark on change that might be disruptive in one form or another. So what they're used to is they're used to this export-led model that they're not about to change course right in the middle, even though this might be in the very long-run interest of China. They're interested in maximizing the number of years that they're in power. So I think that what one gets is not necessarily very smart from an economic point of view, not very good decisions being made, but from a political point of view, it might make a lot of sense for them to go that route.
So we've talked economics up to now. Let's talk about geopolitical military matters. It's often said that the reason the Allies won World War II is that America basically lifted up the Mesabi Iron Range, and dropped it on Germany, and then started dropping, well, they burned the Japanese more than anything else. And it would have been nearly impossible for the Germans to win because of the economic power, the industrial power, even the Russian power at the time. As China becomes this large economic power, will it not also become a much greater military power? And what does that say for the future of the world economy and the world?
Well, I'm basically an economist, not a political analyst, but I would think that this really cannot be very good. It really does have to mean that you get a shift of the balance of power away from the United States towards China. That clearly a very much larger China is going to be able to support a very much larger military, and that China's got many interests in many different parts. And one notices already that we're very dependent on China for getting policy goals in places like Iran or North Korea, the like, that we've really got to kowtow to China. As an economist, what strikes me is China's really got real economic power right now, and it was a very sad sight to see during the global crisis the United States going cap in hand to the sovereign wealth funds of a lot of these Asian countries to ask them to support our banks. That China is sitting on $2 trillion of international reserves, which is massive might. And what you're seeing right now is, I think, China entering into places like Latin America, which used to be our backyard, that I think that this is an indication of the shift. So I would think, that you're certainly right, that economic power really underpins military power, and that is the reason why one has to have some concern. The fact that China continues to grow at a rapid rate, and we've managed to saddle ourselves with a lot of debt, that we are now on a trajectory for lower growth. I think that that is something that most economists would accept, that we're not going to enjoy the kind of growth that we had the last 20, 30 years, that we're now on a slower growth. If China is on a fast growth, this means that the balance really, certainly on the economic side, the balance shifts very strongly and rapidly into China's favor.
So we should avoid, we don't want to be chauvinist about this, and in some respects having a multipolar world is good. And we just worry that all the poles have at least some commitment to democracy, human rights, and peaceful resolution of disputes. We just hope that that's the case.
We certainly hope that that's the case, but what we also hope is that as we move to a multipolar system, that countries operate in a way that enhances the global economy, that you get global cooperation, that what we can't afford is we can't afford countries to be running policies with a domestic view without taking into account the international repercussions. And I think that that is what gives me concern about the longer run global economy, is that China is gaining all of this power, but China is yet to display the responsibility of being a large economic country in the global economy, actually cooperating, either with the exchange rate or with the way in which they behave at the multilateral organizations, the way in which they deal with trade. All of that, I think, is very much an open question, and that only time will tell.
Well, shouldn't it be that why should they do it unless we create some incentive by putting down our feet and saying, you have to respond to these broader world needs?
Right. Well, hopefully, that is what can occur in the end. But it would be unfortunate if China doesn't anticipate that occurring, and we run into a crisis. If we look back at what occurred, in the interwar period, is we really drifted very quickly into protectionism. These little trade skirmishes, have a habit of escalating and getting out of control, and then the whole system breaks down. We certainly don't want to go down that path. We don't want to go down the path where there's very strong political pressure to shut China out of global markets. And I would have thought that the Chinese would anticipate it. Just looking at the way in which they're managing their currency, they're managing their economy. Right now, what they've done is they've introduced a huge fiscal stimulus package that, to a large extent, what it's doing is it's increasing additional capacity in the manufacturing sector to be exported abroad. That is hardly what the global economy needs right now, and it's not very encouraging for the longer run view.
Well, let's hope that they watch this program. Right. Desmond Lachman, thank you again for being with us. And let me say to our viewing audience, thank you for watching us. And if you have any comments or suggestions, you can write to us at policywatch.umd, that's UMD for University of Maryland, .edu. Again, thanks for being with us. And Desmond, thank you so much.
Thanks again.
This program was produced by the University of Maryland, which is solely responsible for its content.
The Norman and Florence Brody Family Foundation is dedicated to exploring topics of national and international importance and is proud to support Policy Watch with Doug Besharov at the University of Maryland.
We are PBS.